Welcome to Central Bank Central. I'm Kathleen Hays. I'm here in Philadelphia at the annual meeting of the American Economic Association with one of the key panelists this afternoon on a very important topic, and that's the dollar and tariffs. Sebnem Kalemli-Ozcan is a professor of economics at Brown University, and she's also the director of the Global Linkages Lab, something that she has spearheaded, this whole great new organization endeavor to look at understanding globalization, how it works, what are the key issues. In fact, some of your recent work this past year, global network, monetary policy, and trade. This is something I love, of course, Central Bank Central. And you also developed a new framework to analyze macroeconomics of protectionist trade policies. So with that, first, thanks for taking time. It's a very busy event for you. It's a very kind of exciting event for economists, professors like you. But let's get right to the point, because you know, we've been talking about this in our interviews for some time. I mean, every economist said, "Oh my God, these Trump tariffs are just going to ruin the economy." But in fact, growth has been pretty good, and it looks like the coming year is going to be pretty good, possibly as well. And this is, you know, with even with closed borders, government shutdown, so they have had some impact on inflation. But not that much so far, some would say. And the economy seems fine. So we're economists wrong?
Well, not actually quite. First of all, thank you so much for having me here, Kathleen. And economists weren't wrong, because economists made those predictions based on the rhetoric in January, February, March of this year that culminated into the Liberation Day announcement, which involved really high tariffs. I mean, remember those numbers, 50%, 30%,
oh God, yes.
100%. So economists made those predictions based on those numbers, and based on those numbers, tariff would have been a stagflationary shock, right? The drop of employment, increase in unemployment, and also increase in inflation. Now, look at where we are right now. We are in January of the 2026, and pretty much after Liberation Day announcement, by October, we settled on quite low numbers, actually. If you look at the effective tariff rates around those times, you know, there were these estimates being 25 to 30% compared to Glass-Whitley Act of, 1930s. Now, if you look at the October numbers, we are talking about 10, 15%. So that's a huge difference, first of all. I would like to make that clear.
Okay.
So, you know, just if you want to take one line from this interview, you know, the smaller the tariff, smaller the impact, right? Okay. Larger the tariff, larger the impact.
Okay.
So in that sense, it is not a surprise. And in fact, our model very early on, actually, as of even before Liberation Day announcement, by March 2025, we did show a range. We said, like, look, if you are going to have 10% tariff, not much going to happen. But if you are going to have a 25% tariff, that's a whole different scenario. So in that sense, economists were not wrong. Yeah.
So one thing that's interesting and kind of stands out is that there has not been a big war of retaliation. And I think that's another thing that surprised economists. That, yes. Oh my God, this isn't certainly what we expected. China and the U.S. have had some back and forth, but they, you know, up, down, sideways. That doesn't seem to be a huge thing so far. Canada isn't buying U.S. whiskey. That's their loss, of course. But for the most part, not a big negative export effect, it seems. Some countries even dismantled some existing tariffs. How important was that? And how do you explain that? What does that mean?
Yes, that is a surprising part. That actually would be one thing if you want to say economists were wrong, because economists did expect retaliation. Now, the explanation for that lack of retaliation, definitely a success of the Trump administration, but we still need to explain why that is the case. Yes. And there are two explanations. The political one, like, you know, countries don't want to be on the wrong side of the Trump administration. That political one can be combined with military reasons, as in the case of Europe. Europe cannot afford not to have American protection under the threat from Russia. So those are like kind of political / military reasons. The economic reason, if you will, is Of course, the countries understand very well this is going to be out of any economic model that when a country like US puts tariffs, dollar is going to appreciate and their currency is going to depreciate, right? So Chinese currency is going to depreciate, European currency is going to depreciate. And they thought that would be a good thing for them because then they would be competitive in the export market. So that might be the economic reason why they didn't retaliate.
So let's look at jobs growth, for example, and the fact that we've seen this weakness because of U.S. demographics, and we've seen the border changes, maybe even because of AI effects starting to take hold. So is there anything in the imposition of tariffs that will provide more jobs in competing industries in the U.S.? People have been very doubtful that you can't get manufacturing back very quickly. But I know that at the Global Linkages Lab, you guys are looking at a lot of numbers. It's not just your work as an economist in the models. It's actually what you're seeing in the data.
Exactly. We actually talk to companies, CEOs, CFOs, supply chain managers, and this is something we have been saying again since March based on our work at the Global Linkages Lab, and this is not the tool, meaning tariffs is not the tool to have a renaissance in manufacturing, right? To bring the manufacturing job back to the US. Why? Because, for that, you need to be cost competitive in production. That means you need to be getting, inputs still cheaply. But if you put tariffs on many sectors, many countries at the same time, you are not going to be able to do that because the jobs you want to create, the labor you want to employ in manufacturing jobs in the US need other inputs to work with, right? I mean, they need plastic, glass, steel, and all those things are things that we import. And now with tariffs, they are going to be more expensive.
Yeah.
So in that sense, for companies to start new companies, to hire more workers, that is not something we foresee in this high-cost environment because basically tariffs are increasing the cost of business. Why you would start a new company? Why you would hire more workers when your cost of doing business is already getting going up? And that's actually another thing the economists were right? I mean, we did predict an impact, a small impact on inflation, which turned out to be true. Inflation is still not at 2%. And also kind of a larger impact on unemployment, right? Labor market slowdown is the key reason why Fed started cutting the interest rate. So in that sense, not only that the jobs didn't come back or we didn't create new jobs because it's a high-cost environment thanks to the tariffs, even tariffs end up being small, still it increased the cost. We also, I think, losing the jobs. So there's this kind of slowing down in the labor market, which is, it's a curious phenomenon because at the end of the day, maybe, the economy didn't crash and burn, but the whole policy, whole trade policy and other policies created a lot of uncertainty. And uncertainty is not good for a dynamic economy.
That's interesting. I'm glad you said that. Recent conversation, I can't remember what it was, saying at the beginning, everybody pulled back. And you can even see it in the data. And now people are going, well, maybe it's not going to be so bad. They're not so sure.
Yeah.
I want to mention something, too, about prices and the delayed impact, perhaps, of some of these tariffs. Because we live in a co-op building here in New York City, and we're getting a new neighbor, and they're going to redo their apartment before they move in. It's an old building. This one hasn't that particular apartment, not anything done for a long time. Anyway, so we were talking to them, and they were saying about what they were going to do with where they're going to put their washer and dryer, and how they're getting ready to by a European brand, I don't want to give anybody extra pushes here, that is, in a couple more days, it's going to be up $500, $1,700. It's a real nice brand. And like that, so they went right in already to put their, get it all going, right? So is that partly what's going to happen, that we're going to see more impact over time, that we haven't seen as much as we thought, but that's going to start feeding through?
Exactly. This is another thing that our model always had, right? A lot of those big numbers also came out from the trade models that doesn't feature this type of sluggish adjustment of prices, what we call in economist jargon sticky prices, right? But we work with a macro-ish type of trade model, so we always had that assumption built in that prices are going to adjust slowly, there's going to be sluggishness there, and also there's going to be many players there, right? Importer is one, of course, but then there's also the distributor, retail.
Sure.
So there are a couple, stages there, and that's all going to, everybody needs to going to adjust a little bit, but at some point, if the tariffs end up being too high, they are going to pass down to consumer, but this is going to take time.
So what are you hearing then from all the CEOs and CFOs and all kinds of people in these companies you're talking talking with, because if it's coming through now potentially, are they also saying? Because remember I don't cover I guess trade as much as I should have. But you know the whole menu trend. What's it called? The menu impact.
Yeah, menu cost.
Yeah, menu costs. You can tell them what it is, but that the people don't want to immediately change.
Exactly.
They can't change it all the
Exactly.
time. So is that maybe what we're going to see now? But what are the companies you're talking to saying about that?
Exactly. So we are we are asking, so that's more kind of explaining, how long it's going to take to come to the consumer prices. We are asking more on the producer prices side first, because
Okay.
that's how it's going to start working on. Remember, both Home Depot and Walmart CEO said it's going to be some time, but at some point they have to start passing this through, to the consumers. And we were talking actually to the construction sector. Why? Because there's this huge investment in these data centers, electricity centers, because of the AI investment boom. And, construction sector is a sector where we buy a lot of inputs from outside. For example, this rebar, a key input to the construction sector. If you look at the BEA numbers for the producer price increase on the rebar, it looks like 14% in the aggregate. But when we talk to these supply chain managers and the CFOs and CEOs, they are talking about more like a 35%
Wow.
increase. So
That's a big
clearly
one.
on the ground it's much higher, but it's going to take some time when it's aggregated up to see in the aggregate price.
And that's something that gets more produced, right? Manufactured. What about something as simple as lumber?
Yes, exactly.
And
This is-
Canada,
yeah.
U.S., and of course that's where the
Exactly.
big, more kind of political pushbacks is.
Exactly. So I think we are going to see more price increases, but of course that then we can also see from the government, we are even now going to reduce tariffs, right? It's just such an uncertain trade policy. We really don't know how this is going to go. But it is, if the tariffs, they are now much lower than the Liberation Day announcement, but they are still not 2%. Remember, as of 2024, we have an average of 2% tariffs. We are still somewhere around 10-15% numbers. If this stays around this, assuming no more reduction, it is going to be more price increases for sure.
So let's talk a little bit about your model, your very new Keynesian, I guess, model to assess the impact of tariffs on the economy. And we know there's always cross currents, and you have to pull out what the cross current is, and then I guess isolate and be able to explain what that impact is. So what is it at this point when you step back? Give us your model. Give us the let us imagine a chart or something. What does it say is going to happen next?
Well, I think, again, if nothing changes after this point, assuming there's no more shocks to the uncertainty and then the tariffs stay around, kind of 10-15% level, we are going to see, higher prices. And that means at some point, Federal Reserve has to stop cutting the interest rates. And they have to, go back to fighting inflation, because then they are going to realize this inflation can be sticky, right? So they don't want that. They were on their path towards 2%. That process now stuck. They prioritize the weakness in the labor market, but at some point they have to go back to, fighting the inflation, meaning increasing interest rates or not cutting, and that can have another kind of slowing down impact on the economy. I don't know if this is going to happen or not, but that's what our model says. Our model would say the final impact of tariff on inflation and unemployment is going to depend on what monetary policy does.
Well, so what if they don't? What if they keep cutting? This is interesting. That's another one of our favorite topics when we do interviews is the Federal Reserve and what it's going to do, when it's done other global central banks as well. But because you were one of the early people who thought when the rate cutting started, that they were going to do it, they should do it. So it's very interesting to me to say, my model's saying they better stop cutting rates.
Yeah.
Do you think they'll have to hike rates, and do you think they'll do it? This is a Fed that looks pretty dovish right now.
Yes, I'm worried about this. I'm from an emerging market, and that's how my views shaped on this thing. If they are pretty dovish right now, because yes, they are prioritizing labor market. But if we don't get back to 2%, which is the inflation target of the Fed, and if they kind of look like to the financial markets they are giving up on inflation, then they are going to lose their credibility, and then it's going to be very hard to bring the inflation back to 2%. So I don't think they will do that, because U.S. Federal Reserve is the central bank with the most highest credibility on the face of universe, and that's exactly why they they can come back very quickly from 9% COVID inflation without moving expectations, where all the other central banks had this inflation expectation increasing. That is because, Fed has a lot of policy credibility. But again, I mean, they have to go back to 2%. It's very important that if this inflation sticks at this point, which is around now 2.7, 3.1, depending on what you look, PC or CPI. And then if it stays there, they have to stop cutting, and they have to go back to 2%.
The panel is about the dollar and tariffs. So let's look at the dollar. What's the impact on the dollar? And this is after a year of from a high peak still. Dollar down, about 9% or so. People are wondering, and a lot of people are expecting it to maybe fall further this year. Markets are watching. That's one of the things we're watching very, very closely. What do you see there?
Yes, so the dollar, I mean, again, in our main model, the network model, we also have, of course, the model prediction that dollar is going to appreciate. Why? Because with tariffs, you switch the demand from Chinese goods to the US goods, right? That means there's more demand for your currency, so dollar is going to appreciate. But we've seen dollar depreciating, so we kind of added a twist to the model, which is what I presented today, and that's policy uncertainty. So we basically said it's not just the tariff itself switching demand to your goods, but it is the way that tariff is done. With a lot of uncertainty where agents today don't know what the tariff will be tomorrow, they don't know if it is going to be implemented or not, if it is just going to stay as a threat, right? If that is how the trade policy done with a lot of volatility around the tariff, then this can impact the exchange rate and it can depreciate the exchange rate. Why? Because now suddenly households is like, oh, wait a minute, maybe I should also do some precautionary saving because I don't know what's going to happen in the future. And the financial markets is like, okay, if I'm going to transact in dollars, then I need to really demand a higher premium to do these transactions, right? Because it might be like now this is maybe getting in the territory of risky currency. Maybe it will depreciate in the future. I don't know, but I better hedge myself against that. So those type of behaviors is going to lead to depreciation of the dollar. And when we actually put these channels in our model, we can match the depreciation of the dollar that happened in April. Now, moving future, what is going to happen? This depends how household expectation and financial market expectations shape, right?
Okay.
I mean, do they think that these type of policies keep coming? All sorts of policies that are volatile, erratic, and like you don't know what is going to be the next thing. Or they think this was just the initial phase of this administration, they are done, and it's going to be business as usual. It depends, how they are going to form their expectations, both the households and the financial markets.
Okay, so if you kind of step back and take a little political economy look at this, that what is your sense, it's a very subjective question, about Trump and how important tariffs are now? Oh yeah, it's a big deal, he still loves tariffs, but is there do you sense any shift in where that is on the list of things to do? You know what I mean? What they're really going to push for? A lot of geopolitical issues. Ukraine war. We saw the U.S. Arresting basically the Venezuela's president and his wife. Nobody, I can't. If you want to give me an idea there, go right ahead. But everyone's still trying to figure out. But it's happened.
Yes.
So where do you think what's the momentum going into 2026 for where the president and his team are putting their attention? And particularly when you see, is maybe tariffs going to be a little more of a back seat? Do you sense that, or do you think it's still?
No, that fair enough. I mean, I fully agree that it is a geopolitical government, right? I mean, like the government is using all sorts of economic tools for geopolitical objectives, and tariff was just one of those tools. But maybe now there's going to be more blunt tools, right? Outright interventions, or the threat is not a tariff threat, but it's maybe a military threat. So, I mean, it seems like maybe for the time being, tariffs can be actually a second-order issue, unless, again, they will be back to the table as a geopolitical tool. Yeah.
One more question, and that's to tell us a little bit more about the Global Linkages Lab. You're the director. I'm sure you guys have mapped out a lot of potential papers, so many things. But what if we go there, what are we going to find? Where's the emphasis going to be now this year, 2026?
Yes, we would like to now really go very deep in the microdata side, really look at under the microscope, how the global linkages, especially supply chains and financial linkages that fund those changes in supply chains evolving. Because it is very hard to rewire the global trade and finance, to change the supply chains in a sense that, okay, I'm not going to buy from China now, I'm going to just go to another country, Vietnam or India. I mean, even you go to a neighboring country, that's a very, very hard thing to do. So we would like to understand how that process is unfolding, how that is evolving, who are the financiers behind it, and you can only do these things if you look at a very, very micro level, both on the trade side and the finance side.
Okay, and again, how can we find that, the Global Linkages Lab?
globallinkageslab.org, and you can see everything there, and we are going to start actually putting some of the data out in an aggregated form, of course, so that
That's
people
cool.
can also use it. Yeah.
There you go.
We would like to also give it this as a public service.
Well, fantastic, fantastic. Well, thank you so much.
Thank you so much, Kathleen.
Sebnem Kalemli-Ozcan, she's a professor of economics at Brown University, and if you want to know more about her, she's got a lot of papers, a lot of research online you can look at as well. Thanks
Thank you so
much.
much.
Great
Thank you.
to
It's a
see you.
pleasure, as always.
As always, I'm Kathleen Hays, and this is Central Bank Central.